How to take profit like a pro. That's what I'm going to teach you today. Yep, most people are terrible at taking profits. Have you ever experienced the market's going up, you're in the market, you're making lots of money, whether it's Bitcoin, Ethereum, Polkadot, or one of the smaller cap coins, only to see it retrace back 50%, 60%, 70%, and all your profits on paper have disappeared? Well, I'm going to show you how to take profits like a pro. I'm going to teach you today. If you don't know me by name, my name is Jagir. I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro. Been trading currency for over 15 years. But now I exclusively focus on crypto and blockchain. I was featured in this best-selling book in 2008, High Probability Trading Strategies. There's some key pieces of wisdom that we're going to pull out today. So if you like today's video, like, subscribe, hit the bell notification. If you know anyone that has ever given money back to the markets, we want to be taking money from the markets. Anyone that's given money back, holding a position when it's drawing down, share this video. I will really appreciate it. So let's look at a video very quickly before I cover the lesson, because I'm going to teach you today. On May 10th, I did this video on Ethereum, right? And as you can see, Ethereum was going up and up and up. And my video said, hey guys, it looks like there's panic buying occurring. And when this particular pattern occurs, we will tend to see a correction. A correction seems to be looming right around the corner. And literally, I drew these lines on the chart on May 10th that said, look, even though it's bullish, price is 4,200, 4,300, 4,400 of Ethereum, is likely we're going to see a correction, so you should be looking to take profits. And then if we look at the actual chart, boom, we saw this amazing correction. Look, this was May 10th. This over here was May 10th. Literally the following day was the high, May 11th, and we saw this massive correction. So just look at that, boom, and we projected that. So I'm going to show you today how and why I projected that. It wasn't just mystical forces kind of going, hey, I'm just kind of feeling the vibe today. Looks like Ethereum is going to be going down. No, there was a logic and method to the madness. So that's what I'm going to show you today. And then also Dogecoin. Some of you love Dogecoin, some of you hate Dogecoin. Independent, right? Based on the chart pattern, Dogecoin back, I think this video was May 6th. May 6th was booming, right? Booming. And I had friends coming to me saying, hey, Jagir, we need to get involved in Dogecoin if we haven't already. And I'm looking at the chart pattern saying, Dogecoin is due for a big correction. And if you watch my May 6th video, you'll see on the video itself, I said that we're going to see a typical ABC style correction. I think we're going to. It's more likely the probable outcome. So if people were asking me and they were holding Dogecoin at this point, I was like, look, you should be looking to take profits. At least some profits. At least take your money off the table where you're risk-free. But if you're in significant profits, you should be looking to exit at this kind of stage because of a particular pattern. What happened with Dogecoin? Literally 3 days later, that was May 6th. So May 6th was around literally here, right at the top. Like, talk about hit the nail on the head. It was right here. And then look what happened. Boom, big correction. So, typical corrections are A, B, C. So that's what we're going to jump in today. So if you like this video today, like, subscribe, hit the bell notification, share this video, because I'm going to give you my top secrets today. So I'm going to pull up a PowerPoint because I want to try and get these points really, really clear. So we use something called Fibonacci Ratios. I'm going to read you a couple of things. So Leonardo Fibonacci, I discovered recently, that's not his actual name, but I'm going to call him Mr. Fibonacci. He discovered, or Ralph Nelson Elliot discovered, that when there's a coincidence of time, price, and pattern with certain ratios, trend change is highly probable when a market trades into a time, price, and pattern zone. That's what we're going to cover today. That'll make more sense by the time we finish today's video. Fibonacci ratios, right? A series of ratios. This is what Fibonacci ratios are. It's important to know because we're going to cover it. It's a series of ratios related to the to the root ratio 1.618, also called the golden mean or divine proportion. These are the most prevalent ratios found in all forms of natural growth processes, including the process of mass psychology. So basically, Fibonacci realized in the world, there's a lot of things that apply to this 1.618 ratio. And there's some very intelligent people back in the 1800s and the early 1900s and mid 1900s said, hey, I wonder if these ratios apply to mass psychology reflected in the price action in markets. And it turns out they do. They do, and incredibly well. I want to just throw this in there. Have patience with yourself because everything is difficult before it's easy. It's a common quote that I quote. It's mainly because I'm going to cover Elliot wave today and I'm going to cover Fibonacci. I'm going to try and stick to the main ratios because there's many ratios. And I'm going to try and explain it into a way that's practical so you can use it as well. So just a quick recap. If you've seen my previous videos before, you know I use a lot of Elliot wave theory. Elliot wave theory, again, is just measuring mass psychology. And typically markets move in a 5-wave structure. 1, 2, 3, 4, 5. That's what we're going to focus on today. How do we, I said, you know, how to take profits like a pro. Well, what I mean by that, how to take profits like a pro, is how to identify a highly probable end of a wave 5. You see why I'm circling this here? End of a wave 5. We want to see in advance when this kind of mass psychology is reflecting in the price action where there's a 5-wave structure, and what gives us a strong indication that we're at the end or close to an end of a highly probable end of a wave 5. So 1, 2, 3, 4, 5. Because what typically comes after an end of a wave 5 is a 50 to 78.6% correction, like big corrections, depending on different structures, but typically 50%. So it's a big pull down. Now, sometimes those pullbacks can be like 1 month, 3 months, 6 months, depending on the time frame, but we don't want to hold. I'm not suggesting that you should hold unless you got like a 20 year plan, like a long-term Bitcoin buy and hold strategy. That's fine if that's your strategy. But if it's like you're getting into a young project and you're looking to get a 10x, 20x, and it's making this pattern, you don't want to be holding. You don't want to make a 20x, which is 2,000%, and then have a 50% drawdown or 70% drawdown where you're giving all your profits back. So that's what we're going to focus on today. How do we identify this with high probability? Now, one of the ways is when a chart structure, the pattern looks like this. Now, it looks differently in real life. This is like the theory, and then we're going to look at the real life. The Ethereum and Dogecoin we're going to use as our examples today. So pattern. So wave 5 has... It's a 5-wave pattern, but this wave here actually also breaks down into a further 5-wave pattern. Wave 5 tends to have a 1, 2, 3, 4, 5. You'll see me talk about that a lot when I'm doing my technical analysis. And that's what I mean by here, 5 waves of a lesser degree. So this is a wave 5, but then you have a 1, 2, 3, 4, 5, and then a 1, 2, 3, 4, 5 in this section. I've deleted that today just because there was a lot of information on this particular lesson. The key things I want to focus on today is the price. Fibonacci price retracements and alternate price projections. There's a few key ones that I want to focus on to help you out. So when you see this structure, you can apply some of these Fibonacci alternate price projections to say, hey, typically at end of a wave 5 reaches this point as a maximum. If it's reaching close to that point or goes beyond that point and it overextends, you should be looking to take profit, some money off the table before a big correction occurs. So price, the following tend to be the typical outcomes if wave 3 is an impulsive wave. What the heck does that mean? Well, when we're identifying an end of a wave 5, wave 3s tend to be the biggest wave. And when this is the case, there's typical ratios that apply. So the typical ratio is wave 5, which is this wave here, often equals 100% of wave 1. So there's a direct relationship with this initial wave and this final wave, right? That's important to know. This initial wave 1 and this final wave 5. A lot of the time, wave 1 and wave 5 will equal each other in time and actually price, but we're going to focus on price today. And the typical maximum is wave 5, if it's overextended, is 1.618 of wave 1. That's what this means over here. I'm going to show you in TradingView, which is software that we use, how that actually applies in practical sense. So now just look at this. Again, I'm going to show you the theory first. So wave 1, this is the distance of wave 1. We're going to measure it. That's 100% of wave 1. And then we project it forward for wave 5. I'm going to show you how we do this in TradingView. So then we'll have this particular price. This is called an alternate price projection. We've measured wave 1 and we're going to project it forward from the end of wave 4 and project it up. And we're going to do this in advance. You'll see a lot of my videos I'm projecting in advance. Doesn't mean it will always pan out perfectly, but especially when you're looking to take profits, it's just high probability. And then we want to look at the next one. This is probably the most common one that I use. Wave 5 will typically be 38 to 62 to 100% of waves 1 to 3. What the heck does that mean? Well, here's wave 1, here's wave 2, and here's wave 3. But we're talking about wave 1 to wave 3. So if I draw that out here, this line here measures the beginning of wave 1 down here and it goes all the way up to the top of wave 3. If we measure that, which is 100%, I'm going to show you how to do this. It's much easier to do on the software when you identify the waves. One of the most difficult parts is identifying a wave count that looks correct. And also keep in mind, there's only 50 to 70% of the time, more close to 50%, that a wave count is going to be clear. Often you just look at a chart and there's no clear wave count, so we never force a wave count. We just move on to the next market or the next opportunity. So we have to just look at different information. So what we're doing here is we're measuring this wave 1 to wave 3, and then we're going to project it forward from wave 4. And this projected forward from wave 4, again, this is the theory, I'm going to show you the practical, is the 62%. This is the most common. 62% of wave 1 to 3 is very common that will be the end of a wave 5. And the typical maximum will be 100%. So wave 1 to wave 3, projected from a wave 4, up here it will be off the charts, literally here it will be off the charts, 100%. And if it's reaching that 100%, it's normally an overextension, which means the upside potential, the upside should be limited, and we should see a correction. And I'm going to show you how we saw those with Dogecoin and Ethereum. And again, we're seeing this ahead of time. It's all well and good when you're doing technical analysis in hindsight, because the chart patterns have already unfolded. You can't make money off history. You have to make a decision today based on future performance. So these are leading indicators that we're looking at. So wave 5 will typically also, this is the last one that I'm going to do, but I'm really going to focus mainly on these top two. But this one's also quite important but again, it's difficult if you haven't done it before, but I'll cover it with you because you can kind of go through it, and I can maybe touch on this in a future video. So wave 5 typically ends at 127% to 162%, whichever relationship to the 1.618 golden mean, which we were referring to before. External retracement. What the heck's an external retracement? Well, you measure wave 3 to wave 4. You measure the wave 4. So I'm going to draw this out here. We're going to measure this wave 4, the distance from wave 3 to wave 4, and we're going to project in the opposite direction. That's 100%. And then you'll get a retracement in the opposite direction of typically like 1.628 or 1.62, which is 1.618, just to the nearest whole number. It's projected ahead of time. And when you get a cluster of Fibonacci price projections, that tells you there's a high probability that the price will reach that point, and it's a strong reversal zone. And the trend, you'll often see a trend change when you see this. So what we're going to do now is, that's the practical. Sorry, that's the theory. We're going to now go into the practical, because again, let's jump back into the YouTube video on May 10th. This is what I saw. So now we're going to just jump into a live chart, but we're going to just backdate the data. We're going to backdate it, and I'm going to show you how I do it time and time again to maximize profits, because you don't want to be holding, like I exited all my Ethereum around here. You don't want to be holding during this big pullback. It's a big pullback. That's 50-60% pullback. Like if you made 20 grand, 60%, you're giving back 16 grand to the market. You don't want to be doing that. So you want to be, really, really selling near the top, wait for a high probability setup and buying again, depending on your strategy. Again, if you have a long-term buy and hold strategy, I call it the Michael Saylor strategy, where you're holding for 5 years, 10 years, you don't need to worry about it. Warren Buffett does a similar thing. But if you're holding for like 3 months and you've been working hard to get yourself into a low market cap project and you've made 10x, 20x, or 5x, 3x, whatever it is, you want to have a high probability selling point. So let's just backdate the data. So TradingView allows us to backdate the data. So I'm going to take the data to down here. Right, I think the date is March 26. Now, Ethereum was unfolding, I had this wave count 1, 2, 3, 4, and there's this final leg of this wave 5. But what you'll notice is a wave 5, like we said in this chart here, it often breaks down into 5 waves of a lesser degree, right? Lesser degree. So what I saw here was this initial wave 1, and you often see me do something like this in my videos. I'll say, look, an initial wave 1 looks like a wave 2. We should see some type of wave 3, 4, 5. You'll typically see me draw something like that. Obviously, we're doing this in hindsight, but you know that I did this video on May 10th. So I'm just kind of going back in time to say, look, how did I get to this conclusion? But I'm going to show you exactly how I got to this conclusion, right? So I will anticipate a move like this. So let's just let the market unfold. So when the market unfolds, it's gone above this wave 1 high to say, okay, wave 3 is forming now. Now, a typical, let's just actually just focus on the wave 5. Let's just get right to the point, because otherwise we'll boom, 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 boom. Okay, when I see this, so let's just delete this now. Or actually, let's just delete these lines. I know we got all this information here on the right. That's because it's more recent analysis. Let me see if I can just get rid of it like this. Right, so we know the market gets here, but let's just say we didn't know that at this stage. We've got this wave 1, wave 2, wave 3, what looks like a wave 3, and we can kind of pull this down, what looks like a wave 4, and then the market is starting to unfold. Right, so now what we're looking at is a wave 1, 2, 3. Let's just pull this over here. Now we want to do the projections ahead of time to say, okay, if this is a wave 1, 2, 3, 4, and we're on this final leg of this wave 5, where is a typical wave 5 maximum? So if we just kind of jump back into this chart, let's just focus. I'm just going to focus on this one, actually, this one, because this will give you more than enough information. Because sometimes when I cover too many of the retracements too fast, I know it can be very confusing. You want a piece of information that just says, right, Gear, what's the most important one? Is why I put it in bold, is this one here. These are also important, but this one's the most. If I had to choose one, this is the one, which is a wave 1, a wave 5 will typically be 38, 62 to 100% of wave 1 to 3. All right, so now we're going to do the practical side of things. So we're going to go to this tool here on TradingView. It's called, I don't know if it's got a name. Press this arrow. We want to go right the way down. And the thing we want to click on is called trend-based fib extension. That's what it's called in TradingView. Different platforms or different softwares sometimes call it something different. But in TradingView, which is what we're using, you can get a free version of TradingView. It's called trend-based fib extension. So we click on that. And what we're going to do now is we're going to measure this beginning of this wave 1 to this end of this wave 3. So if we just go back to this, it's beginning of this wave 1, and this arrow here is what we're measuring. Beginning of wave 1 to the end of this wave 3. So we've got 1, 2, 3. We're going to measure this distance. So that's going to be step 1. So we click down here. That's the first click. With trend-based fib extensions, you need 3 clicks. So we just done our first click, which is the beginning of this wave 1. Then at the top of this wave 3, that's our second click. And then if we just jump down here again, and then we're going to project it forward from the wave 4 low. So when you're quite confident, because we made a new high over here in the live chart, we want to project it forward from the wave 4. That's going to be the third click. So now if I just jump back here, the third click is going to be, boom, here. And now if I double click on this, or if you just take this will normally pop up and you click the cog, this cog here, it allows you to select the numbers that you want. So what we said here, that was a collage of a gift that I made for my wife. If you just saw it, that's my screensaver. Married for 10 years, so what the ratios that we want is 38%. Sorry, 38% is the typical minimum. The most common is 62%, and the typical maximum is 100%. So the two that you see me most common use is 62% and 100%, especially in crypto when a lot of the wave 5s tend to be overextended. So we've got 62% selected already, which is represented as 0.618, which is this line here. We can see we're at that price already, and then the 1 represents 100. So now we've got these 2 Fibonacci price extensions, right? We've measured wave 1 to wave 3, projected it from wave 4. We've got these 2 price projections. I'm going to keep it just as that. Normally I would do the wave 1 price extension, or maybe I'll just do one more. I'll do one more for you, just so you get the picture. Because we want a confluence of events. Because though this ratio is very powerful, when you do the other ratios, especially on multiple time frames, you'll get a cluster of price projections, and that's when it's really, really highly probable. So let's actually just do this one also, because this one's also very important. Wave 1 has a relationship with wave 5 and vice versa. And the typical is 100%, but the maximum is 1.618%, which is represented as 162%. When price is at that point, you know the upside potential is reaching its top. So now when we jump on this, we're going to do the same thing again. We're going to click on this. We're going to click trend-based fib extension. This time what we're going to do, rather than measuring wave 1 to wave 3, this time we're going to measure wave 1 itself, this low to this high. So we're going to do this part here. we're going to measure this part here, this low to this high, and then we're going to also project it forward from wave 4 itself. So here we're going to go bump, bump, and then project it forward from wave 4 itself. Now, with different softwares do it slightly differently. You'll notice that actually I'll leave it like this. Let's just keep it simple. We'll keep it simple. We'll keep the lines long. Sometimes I like to pull the lines across, but it's fine for what we're doing here. So the ratios now that we want is the 100%, and the typical maximum is 1.618. So what we're going to see straight away is, well, the price has gone above this as well. When the price goes way past a Fibonacci cluster, the next resistance zone will typically get to the next zone as well. So what we can do here to keep the chart nice and clean is we can get rid of this one and just go, right, now we have this strong Fibonacci end of wave 5 target. So what I would do in this case is, because we've reached this zone and we're coming close to 100% of that typical maximum of a wave 5, I would now look to start either adjusting my stop loss if you got a stop loss in play, or looking at a logical position to take profits. So I'm going to change the chart to candles, because candles just show every bar here, every candle. This here represents a candle, like it represents one day. It's a daily chart. What I would do here is I would look if there's another pattern here that also represents a 5-wave structure, because then it'll be a wave 5 of a wave 5. That's a bit more advanced, but let's just focus on the price. So we can also look at momentum and everything else, but we're just going to focus on pattern and price today. What I would typically do is, here we go, 1, 2, 3, and if I just let the data unfold, now we are past this point here. So this is the typical wave 5. The current price is only 3,400. Now we know Ethereum went to 4,400 as its all-time high. We know that, but we didn't know that at this time. So you would have to make a decision at this point here. Now my decision was, all right, I want to now trail my stop loss at a 1 bar low. I would also use a momentum indicator like this that says, look, it's overbought, it's reached, a high Fibonacci price cluster. We're approaching a wave 5 of a wave 5. Okay, I would like to exit part of all my position or all of my position at a 1 bar low. What that means is, if I just get rid of these just to clean up the chart a little bit, let's just keep it nice and clean. Is what I would do is I would say, if the price goes below the last bar, I want to exit, because that will be the first indication that we've reached the top. So then we will let the bars unfold, and then I would go, right, the next day, because we're at this end of a wave 5 price zone, I go, the upside should be limited. And now we've got a bearish momentum reversal as well. So I go, we've got a momentum reversal, we've got a pattern unfolding, a wave 5 pattern unfolding, and a Fibonacci price extension zone, which is a typical wave 5 maximum. You can see the price went higher. So now I just adjust my stop loss on my, on CoinMarketCap, you can use a price alert. So you can set a price alert. You can say, look, if the price gets to 32,000 or below, I want to exit, or get a notification so you can take action. Then the price went higher again. I would then adjust my stop loss again. Then the price boomed up again. So this is one of the reasons why it's good to adjust a trailing stop loss. But look at this, look how far we've gone past this 100% price projection, which is the typical maximum. It doesn't mean it's going to just hit there. What this just tells us is we are seeing panic buying. Panic buying, people FOMO-ing, fear of missing out, and now it's an overextension of a wave 5. When there's an overextension, buying, like the money coming in to buy, is eventually going to run out. It's not sustainable. Look how steep the curve is. It's just going directly up. It's not sustainable. So if you're in this position, I want to be thinking, right, I want to be taking profits. I don't want to hold, because typically after a 5-wave structure, especially on a larger degree, we'll see a big pullback. So now let's just see how it unfolded and when we would have got exited. So now I would have adjusted my stop loss. This is literally what I was doing, by the way. Adjusted my stop loss. So now we've adjusted it up to 3,700, and the price is currently at 3,900, and we would have got stopped out there. Bang. Would have got stopped out if it was a stop loss on a platform, so you know. But then let's just now look at what just happened, right? The market, and look at this big correction, boom. big correction, all the way down to where we are today, all the way down to this zone here. Right, let's just pull it back to here. So we went from as high as 4,300. Here we would have exited like a pro because you would have captured most of the move, because you can't capture all of the move, but you want to be looking to enter near the low and exit in near the high. Now when I did this video, you can see I said, look, we are approaching a wave 5. It was a wave 5 of a wave 3, but it's a wave 5, and then we should see a big correction, which was what we saw. And now you can see that the theory matches up with the practical, right? So now would you like to see, we'll do the same thing with Dogecoin, but Dogecoin will do it a bit faster, right? Because I just wanted to go slow and steady to go, right, this is what it looks like. So Dogecoin, we did the same, right? On May 6th, we had this beautiful 1, 2, 3, 4, 5 pattern. A lot of people coming to me saying, hey, Jagir, we should buy Dogecoin. Dogecoin's in the news, it's booming, millionaires are being made from Dogecoin. And I'm looking at this chart structure and saying, not for me, thanks. This is like a overextended wave 5. Let's have a look at Dogecoin. So we can see what happened. But what did I do at the time it was happening? Well, let's just take it back to May 6th. Take the date to May 6th, which was here. This was the date of the video that I did. If I just extend it like this, we'll see I did a wave count, which was 1, 2, 3, 4, 5. And I said, hey man, this is looking like an end of a wave 5 zone. End of a wave 5 zone. And what we do is the exact same price projections that we saw before. It's just the exact same. When a pattern does unfold really, really clearly, we can just literally do the exact same thing. We don't have to reinvent the wheel or anything. So we click this, we go trend-based fib extensions. Let's just keep it simple. Let's just get rid of the indicator for now, because we're just gonna mainly focus on the price. We're gonna click the beginning of this wave 1, end of a wave 3, that's the second click, projected from the wave 4 low. Just make sure I got that right. Did it one more time. Boom. Boom. And boom. Yeah, and what we want is the 62% is the most common, and the typical maximum is 100%, right? Now, obviously this is done in hindsight, but at the time, I did it at the time, like a leading indicator before the market corrected. Before the market corrected, you can go back and watch the video on May 6th, you'll see it. But this was the method to the madness. It was saying, hey guys, I am not buying Dogecoin right now, because a typical wave 5, as we saw in the theory, is 100% of wave 1 to 3. Yeah, that's a typical wave 5 maximum. Maximum is a 100% of a wave 1 to 3. So we measure it from the bottom of wave 1 to the top of wave 3. That's what we've done here. This bottom of wave 1. So let's just draw this so it's really, really clear. Sometimes I know this is a lot of information and everything is difficult before it's easy. Where's my arrow? I'm looking for the, here we got this one I'm looking for. Beginning of wave 1 to the top of wave 3. Well, that's what we're measuring, and then we're projecting it forward from wave 4. So you can see that's where that line is. That's the line that we're drawing, measuring wave 1 to 3 and projecting it from wave 4. And then we've got this line. So when price is now giving us, there's two key pieces of information here. We've got this pattern, this Elliot wave count, 1, 2, 3, 4, and we're coming towards a 5. And at the time, we didn't know that that was going to be the end. It's just high probability. That's what I'm trying to always get across. We don't know for sure, just very high probability. It's hitting this 100% price extension, 1 to 3, measured from 4, projected forward, boom. So straight away, and then if we bring up the indicator, we go, okay, this indicator is now getting overbought. So we've got pattern, we've got price. I know we've only done the main one, the 100% of wave 1 to 3. We've got momentum, and there's a few other things we can do as well, but that's a confluence of events, 3 things telling us that the upside potential is going to be limited. So right now, when my friend came to me and said, hey, Jagir, we should be buying some more Dogecoin, I'm like, hell no. I said, have you got Dogecoin? If you have, you should be looking to sell right now. At least take 50% off the table. At least take your money back off the table. So if you invested 10 grand down here and you're like 100 grand up, you go, and it's like a 10x, you want to be going, right, at least exit your thing, but I would be looking to exit the whole thing. So now let's just do the same thing as we did before. Let's bring up candlestick chart and say, all right, we're reaching this high. I'm convinced, you know, my logic, objective mechanism says, right, we're looks like we're reaching a high. Let's now just trail our stop loss or have a push notification with CoinMarketCap. Say, hey, when the price, here's the 1 bar low. Let's just unlock the data. Here's the next 1 bar low. Right, so we move the stop loss from here to here, or the price notification. This is 1 day at a time. Then the next one, you may have got stopped out here, which would have been around 53 cents. It went as high as 73 cents. And then look what happened afterwards. Boom, big pullback, right? And then boom, boom, boom. And then it just went right away down. And remember at the time, when we drew this, typically a correction is 3 waves, minimum of 3 waves, A, B, C. And this is what we drew on May 6th. And again, we just did some retracements, typical retracements. We're not covering that today. We can see that it just unfolded as the minimum A, B, C. But then it did actually pull back a lot deeper as well. You know, today we're all the way down to 14 cents, as low as 14 cents we've been. What's been the lowest low? And it's not over yet. It's not over yet. We're like all the way down here. So we've been as low as like 20 cents, all the way from 50 cents. So, that was a lot of information, wasn't it? That was a lot of information. That's how you take profits like a pro, right? Project forward ahead of time. You know, you got Trading View. That's probably the best software that I found because it's just easy to use. A couple of other top tips, by the way. You can click up here. You can put in any token. You can write in any token ticker symbol, whether it's Dogecoin, whether it's Ethereum, whether it's Uniswap, whatever it is. You can just put in the ticker symbol here. Click one of the data feeds, basically any chart that is listed. Just click it. It will bring up the chart like this. You might get used to the whole thing as well. But the main thing that I wanted to get across today is how to project forward an end of a wave 5. The most powerful Fibonacci price extension is going to be 100% of wave 1 to 3. And if it's reaching that 100%, you go, okay, it's overextended. Money is running out. Money's going to run out. Like, you know, there's only so many buyers. And then once people are buying and buying and buying and buying, no one's got more money to buy. Now, people that got in early are going to look to take profit. So it's going to be sell, 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 boom. And then it kind of repeats itself as well. So the market's always contracting and expanding. Whew! I need to take a breather on that one. If you liked today's video, that was just gems. I'm hoping you appreciated that. That was like high level stuff, but I tried to simplify it. If you like today's video, like, subscribe, hit the bell notification. Feel free to share this because most people don't know this. Most people, especially if you're newbies, especially if you've only been in the game for 2 months, 6 months, even a couple of years, and you don't understand technical analysis and the psychology of the markets, a lot of people buy in at a good price. And sometimes timing, you get lucky when you're just buying at the right time. If you bought in January, February, those kind of times, things were just booming. Then we had this big correction now. But there's going to be a time in the very near future where things are booming again. And you're going to get into some of those projects, but you can have no idea when to get out. Because people often think that, all right, it's just going to keep going up. Wow, it just keeps going up. Wow, it just keeps going up. But when I see a pattern like this, I go, that is a typical sign of a correction coming. A correction around the corner from an Elliot wave Fibonacci standpoint, psychology standpoint, profit-taking standpoint is just inevitable. It was the same with Ethereum, right? When we see this kind of move, profit taking going to occur. We did the same thing with Bitcoin as well. If you look at my Bitcoin videos from April 19th, you'll see that we projected that high and we're going to see this profit taking and we'll probably see a pullback of 50%. All right, let's finish with a quote from this book. I'm still on this book, The Winning Investment Habits of Warren Buffett and George Soros. So this chapter 13, it says, pull the trigger. There's 4 things I want to read to you today. Pull the trigger. So when we see something that makes sense, we're willing to act. As Warren Buffett, act fast and very big. So in other words, have a plan and then trade your plan or invest in your plan. Time and tide wait for no man. Old English proverb. Time and tide wait for no man. Meaning when the trend is unfolding, it's not going to wait for anybody. And when the trend comes to an end, it's also not going to wait for anybody. So you want to be 1 or 2 steps ahead so you can plan. That's going to be really, really important. Let's finish with this one. He who hesitates is a damn fool. He who hesitates is a damn fool. May West. May West. So in other words, have your plan, have it clear so you know ahead of time, make it objective and mechanical as much as possible. Because if emotions are really like in the moment, dictating your decision making when it comes to investing, you've already lost. Why? Because of fear and greed, fear of missing out, fear, uncertainty, and doubt. It's just hard. That's why 95% of investors and traders lose. Whereas you want to be ahead of the game. So if you can learn some of this wave 5 stuff, that's going to be really, really powerful. So let me know what was your favorite, no, I was going to say favorite Fibonacci extension? Was it the 100% or the 62%? Let me know, what did you find most powerful? Was it the Fibonacci price extension or was it the Elliott wave count? Fibonacci price extension or the Elliott wave count? What did you find most useful today? All right, I'll see you in a future video. That was a lot today, so good job on sticking with it.